Good evening, respected dignitaries, esteemed speakers, and all the participants joining us today. On behalf of the Committee of International Taxation of I, CA Akshita Dand, warmly welcome you all to this insightful webinar on Demystifying Transfer Pricing and Executive Summary. Transfer pricing is often called the nerve center of the international taxation. In today's globalized world, businesses operate beyond borders, and the pricing of cross border transactions between associated enterprises directly impacts fair competition, revenue collection, and global compliances. For professionals, it poses unique challenges from navigating complex regulations and OECD guidelines to balancing litigation risks with business competitiveness. Through this session, we aim to simplify the framework, highlight key principles, and share global practices so that we are better equipped to handle transfer pricing with clarity and confidence. With our distinguished panel of experts, today's discussion promises to be both insightful and practically relevant. I am very much fortunate to introduce Mr. S.P. Singh, ex-IRS officer. Mr. Singh, fondly known as SP, has over 2 decades of illustrious service with the Indian Revenue Service, where he served as the Director of Income Tax, International Taxation, and Commissioner of Income Tax Appeals. He has been a part of negotiations for tax treaties with over 30 countries and played a key role in drafting India's transfer pricing regulations. Recognized globally as a leading expert in transfer pricing, Mr. Singh has also served with Deloitte India for over a decade and continues to contribute extensively as a faculty, author, and thought leader in international taxation. With this, I request Mr. S.P. Singh to kindly provide the overview of the session. Over to you, sir.
Thank you, Akshita, for the nice introduction.
Thank you so much.
Good evening, esteemed participants. It is my distinct privilege to present the overview of the webinar, which stands as a significant milestone in our ongoing series devoted to the analysis of international taxation. Before we begin, I wish to record my appreciation of the Committee on International Taxation, whose foresight and sustained leadership have established a platform of professional excellence, enabling members of our fraternity to thoughtfully engage with subjects of growing complexity and importance. Now, let me talk to you about today's topic, that is demystifying transfer pricing and executive summary. I know many of you are chartered accountants getting into the transfer pricing space. And when I first encountered this subject, I found it quite overwhelming. The good news, it doesn't have to be complicated. Think of transfer pricing simply. When companies within the same group do business across borders, how do you ensure fair price? It is essentially asking what price would two independent companies agree on? That's the arm's length principle. Over the past 20 years, India's transfer pricing rules have evolved dramatically. We have seen comprehensive documentation requirements, structured assessment procedures, and significant court decisions that shaped how we interpret these rules. What makes this field fascinating is that it sits at the crossroad of law, economics, accounting, and most important of all, business strategy. For those newer to this field, here is what I have learned over the years. Understand the business first and then apply the law. It's very important for you to ask a basic question. What is this company? What is this company actually doing? Once you grasp the business substance, the transfer pricing analysis becomes much simpler and clearer. The global landscape have been changing rapidly, with OECD's BEPS project influencing how countries, including India, approach transfer pricing. We are seeing focus on digital transactions, intangibles, and global minimum tax rates. These developments are making rules more consistent globally. What's particularly relevant for today's chartered accountant is how transfer pricing intersects with your traditional work. Many clients need guidance on these issues, and understanding transfer pricing gives you tool to provide strategic advices. Against this background, today's webinar has been carefully structured to present in an accessible yet comprehensive executive summary format the essential contours of the subject. The discussion will trace the global evolution of transfer pricing principles, dissect the Indian legislative and regulatory experience, spotlight current and anticipated challenges, and review, most important, and review the available mechanism for dispute prevention and resolution. In this endeavor, our objective is to move beyond mere technical exposition. We aim to equip both professionals and business leaders with not only practical insights, but also a deeper appreciation of law and regulations. We are exceptionally fortunate to be joined by CA Kriti Chawla ji, whose substantive knowledge and hands on experience in this field promise to bring clarity, depth, and practical relevance to our proceedings. The session will be thoughtfully moderated by C. Akshata Dalalji, whose stewardship will ensure our dialogue remains focused, enlightening, and interactive. As we embark upon today's program, I am confident that it will substantially enhance our collective understanding and encourage active participation in addressing the challenges and opportunities that transfer pricing presents to our profession. It will also reinforce the central role of practitioners in balancing the demands of compliance, policy interpretation, and strategic business advice within an increasingly interconnected global economy. Thank you all for your presence, and I wish each participant an engaging and intellectually stimulating session. Over to you, Akshita.
Thank you so much, sir. Thank you for your insightful overview and for setting the foundation for today's deliberation. Before introducing the speaker, I would like to I take the privilege of introducing CA Chandrasekhar Vasant Chitle, Vice Chairman of Committee on International Taxation of ICI. CA Chitle,
I
sir.
think that's sufficient. No need to further introduce. I'll take it over.
So, sir, I would kindly request you to please give the remarks for today's session.
Yes, thank you.
Thank you, sir.
Uh, Friends, welcome to this particular webinar on nitty-gritties on transfer pricing. As you are aware, that this particular government in its manifesto has stated that they want to ensure non-adversarial tax regime. So maybe there are various provisions which are made subjective. Maybe like you have depreciation, certain allowances, certain deductions, disallowances. So there are so many provisions that if you pay above 10,000, otherwise then banking channels, they are disallowed. So we are now used to this law, which is drafted in an objective manner. But then one area which remains subjective is transfer pricing, and therefore not only the written words but also its interpretation becomes more relevant. For the purpose of transfer pricing, like for other provisions of tax laws, you have to be within the canvas of the enterprise. That how he has earned, how the enterprise has earned, how the enterprise has spent, and what are the evidences therefore. But when we talk of transfer pricing, We have to go beyond the books of account, beyond the territory of the enterprise, and we have to really demonstrate that whatever transactions are done, they are done in a normal manner where the industry or other enterprises are doing. And for that, not only the knowledge of own enterprise is required, but also knowledge of other enterprises are required. And then there are several softwares which provide you this data. But then earlier, there was an issue that you could not get the data. In today's environment, the paucity of the problem of paucity of data has been replaced by the problem of amplitude of data. So really, when you get data and you find, okay, there are in an industry there are say 20 or 25 comparable enterprises where you have to benchmark your enterprise with them to demonstrate that you have dealt with the associate enterprise in an arm's length, then it becomes a challenge. And there you need to weed out certain enterprises. Even for weeding out those enterprises from the comparable, really you have to study those enterprises and find out the features why you are weeding them out. So this is an elaborate exercise. There are various other methods in which you are required to benchmark. The whole study of transfer pricing of an enterprise starts from defining the associate enterprise, then considering transactions. Again, in those transactions, there may be several transactions which are financially transacted. There may be certain transactions which are non-financial. Maybe the parent company is allowing use of logo or some marketing, maybe without charge. How to factor these non-financial data into the financial dimensions, that becomes a challenge. For the purpose of weeding out certain comparables, that is also an examination. So here there are a number of aspects which are subjective. In those subjective dimensions, ultimately there are precedences. So the person or the tax council is guided by those precedences as to how it is done in case of Indian jurisdiction by the other enterprises. Some torchlight is thrown maybe by decisions of AAR, decisions of tribunals, courts, and maybe internationally also there are various models which are available for the purpose of benchmarking. So the whole lot of things are to be seen. Of course, internationally, even marginal costing method, I'm told that it is possible to consider. But in India, maybe we will try to understand from the speaker whether we can think of marginal cost as well. In a sense, total cost may be 100 rupees, but if the marginal cost is 20 rupees, and if you are selling for 22 rupees, whether it would be compliant of benchmarking criteria. So these are various issues which one comes across. Besides these issues, your understanding, your interpretation, it is not sufficient. You have to come out with a documentary evidence, and you have to demonstrate that yes, whatever you have studied, these are the various documents which are there. Wherever certain comparable enterprises you find that they are not appropriate to be included, why you have excluded them, what are the features. So the host of the documentation of analysis that really takes you your makes your job accomplished. Initially, when this particular regulation transfer pricing came to India, people struggled to comply with it. Of course, Indian talent being as it is, maybe within a couple of years, it could cope up with the requirements. And you know, if you could pass test of Indian tax department, maybe world over, nobody would be able to challenge you. And there, actually, for Indian professionals, the gateway has been opened across the globe for the purpose of rendering this transfer pricing services, because these are based on certain models and those models are internationally acceptable. So if you try to understand and master the principles in Indian scenario, maybe worldwide the officials may be a little more kind and you would be able to have a safe selling, and the competitive edge of Indian professionals would be really sharpened by such seminars, such exchange of knowledge, that they would be able to render their services across the globe. And I'm sure that after understanding the principles of US taxation. We already have the course in taxation in Dubai, Middle East. So this transfer pricing is the fundamentally applicable to all these jurisdictions. Maybe certain provisions here and there would be differences, but then not really the differences in principle. So let us try to understand this. We have specific experts in this particular arena who will guide us in transfer pricing. And of course, you, the moderator, would ask the questions in your mind from the audience. So for the audience, if you have any issues, maybe you can post them in chat box, and certainly you will get justice to your questions. And as far as our International Tax Committee is concerned, it is really fortunate to have in our armory none other than personality like SP Singh, who has seen all these developments right since the beginning till today. So whatever is the rest, I think we are really fortunate that Singh sir would be able to uh, advise us in an appropriate manner. So with this, I comment today's webinar to the audience. Thank you.
Thank you so much, sir, for your motivating words, for setting the tone, and giving the aspects to be considered for transfer pricing. It is now time for the technical deliberation of the day. I take immense pride in inviting our speaker, CA Kriti Chawla. CA Kriti Chawla is a chartered accountant, company secretary, and LLM in international tax law from King's College, London. With more than a decade of professional experience across Big Four consulting firms and leading tax law firms, she has co authored seminal books on transfer pricing and principle of taxation law alongside stalwarts of the profession. Currently an associate professor at JGLS and director of its Center for Comparative and International Taxation, she is also serving her fourth term as an expert on ICAI's Committee on International Taxation. We are privileged to have you here, madam. I now request CA Kriti Chawla, madam, to proceed with the technical session.
Thank you so much, sir. Thank you so much, SP sir and Akshata, for this warm welcome. Hello, everyone, and welcome to this session on demystifying transfer pricing. I'm so glad that you have taken out time on a Monday evening to actually come in and attend this particular session and discuss transfer pricing with us. I will now share my screen and we shall get started with the technical deliberations on this particular session. So just allow me a minute. Okay. Akshata, could you confirm if the screen is visible?
Yeah, the screen is visible. You can on this slideshow mode.
I'll do that.
Yeah. Perfect.
Okay. Okay, thank you so much. And let's get started with this particular session on demystifying transfer pricing. We shall, cater to the basics of transfer pricing. And for this, I shall start with, the gap that was appearing, which was a tax avoidance gap. And where was this need to fill in, the transfer pricing regulations? That is what I'm going to talk about. And then we will, build upon this particular concept. We will talk about the definition of associated enterprises. We'll talk about the definition of international transactions as it stands in India. When it comes to transfer pricing, you must have all heard about this term called as arm's length price. So we will talk extensively today about this thing called as arm's length price. Where is the arm's length price originating from, which is basically the arm's length principle? That is what we will be talking about. And finally, we will be talking about the methods to compute arm's length price, both from an international perspective and from an Indian domestic law perspective. After that, I will, briefly take you through the disputes that we commonly as taxpayers, see when it comes to transfer pricing and the dispute resolution mechanisms that we have domestically and internationally to resolve transfer pricing issues. what I've added to this particular slide is also the sections from the Income Tax Act of 2025. So while I take you through the entire Indian transfer pricing regulations, I will also be mindful of keeping in view the Income Tax Act of 2025. So without much delay, let's get started with demystifying transfer pricing. So when I start with this particular presentation, this is the first slide that I'd like to actually display. If you just take a minute and look at this particular slide, I think there is that one word that would come to your mind. And I think that is basically tax avoidance. So, there is actually a difference between something called as tax avoidance and there is something called as tax evasion. If you look at this particular slide, it actually relates to something called as tax avoidance and not tax evasion. Tax evasion is something which is illegal. If a taxpayer engages in tax evasion, they could be imprisoned or there could be fine imposed, etc., under the relevant regulations. However, if you look at this particular slide, it actually signals something called as tax avoidance. Now, tax avoidance is something which is not illegal. It is really making use of the international tax loopholes. These are basically tax planning strategies that make use of these international tax loopholes, and they help us in minimizing tax liability. Well, they help taxpayers minimize tax liability. The thing is that while tax avoidance may not be illegal, the thing is that it's mostly a crime against the society. There is now a growing concern among the general public, as you can see here, that tax avoidance strategies is where the multinational companies are not paying their fair share of taxes. So there's something wrong. It's more like a crime against the society, while there is no imprisonment, etc., for the purposes of tax avoidance. So when it comes to a thing like transfer pricing rules were actually brought in to make sure that these tax avoidance strategies do not happen. And through this particular entire slide deck, I shall actually be talking about what was the problem and why did transfer pricing come in, and how has transfer pricing regulations helped in solving those particular or closing those particular tax loopholes. So let's talk about the simple need for transfer pricing. Well, if you actually look at global trade nowadays, global trade as in transactions all around the world, well, you'll see significant volume actually happens within a particular multinational group. Transactions within a particular multinational group could be anything. Transactions between the parent company and the subsidiary company, or between two different subsidiaries companies in one group itself. So those are intra-group transactions, and about 30% of the world trade actually happens, which is intra-group transactions. But my point here is, what is the problem with intra-group transactions? Well, the problem is that if you look at a transaction between independent parties, and when I say independent parties, I basically mean to say, unrelated parties, parties that are not related to each other, some random independent parties in, the market. Well, when they transact between themselves, there is always demand and supply in operation. They are conducted at open market price. Things like that, the seller would always try to sell at the maximum price possible, and the buyer would always want to procure something at the minimum price possible. And that's how they conduct a transaction, with negotiations, etc., at something called as the open market price. So that's the story for unrelated parties and independent parties. But then the problem is that the moment that a transaction takes place within a particular multinational group, that is the transaction between related parties, or for transfer pricing purposes, we call related parties as associated entities. entities that are associated to each other. So when transactions actually happen between associated enterprises, they are not entirely driven by these market forces. They are driven by, let's say, a combination of those market forces and group driven forces. They are more driven by the common interest that exists between these enterprises. They are driven by the relationship that exists between these associated enterprises. And this is the reason they have an incentive to actually manipulate the transfer pricing, and it's not really reflective of the market driven reality. Too much theory? I'm going to explain this with the help of an example, and then let's see what really the problem is for related party transactions. So let's look at this particular case study right here. In this particular case study, there are two fonts that we will be focusing on. First, let's focus on the black font, and then we will go on to focusing on the red font. So how a transaction is structured, it's when a particular business actually goes global. So let's say that we have a company F, which is in India, and let's presume that the tax rate in India is 30%. Now, we also have a company I, which is in Singapore, and let's presume that the tax rate in Singapore is 17%. Now, how this particular transaction is structured is that company F manufactures in India, sells the manufactured commodity to company I in Singapore, and then company I will further sell the commodity to third-party customers that they have, with them. So the transaction is structured as company F selling to company I and company I selling to third-party customers. Now, as far as let's concentrate on the black font here. And the black font basically signals that company F and company I, they are not related to each other. They are independent parties. They are unrelated parties, out there. So what company F does is that the cost of manufacturing for company F is, let's say, $1,200. And company F decides to actually sell that particular commodity for $1,400. Thereby, they make a profit in India at $200. This is what if you just move to the right side of the screen, this is what I've mentioned here, that the profit in India is $200. Now, the tax that we have in India, the tax rate in India is 30%. So that gives us a tax of $60 on $200 at the rate of 30%. Okay. Now, the product actually reaches company I in Singapore. Company I, the sale price becomes the purchase price for company I. So it's $1,400 right here. Company I decides to put in some extra value addition to this particular commodity at a cost of $100. And finally, they decide to sell the commodity for $1,600 to the third party customer. So if you look at the profit that the company I has made in Singapore actually comes to $100. 1,600 less 1,400 less 100 gives you a profit of $100. So $100 of profit in Singapore. The tax rate in Singapore is 17%, and so the tax is $17. Now, if you look at the tax that this particular group has actually expended, as in company F and company I putting together, the total tax in situation one is going to be $77, 60 in India and 17 in Singapore. So that gives us $77. Now, this is absolutely fine, because this particular transaction is operating at market demand and supply factors. I think there's nothing wrong with this kind of a transaction. But now let's change the narrative. And in this particular narrative, let's make sure that company F and company I are now related to each other. It could be any relationship, and we will be talking about relationships in detail later, but it could be the relationship of, let's say, a parent company and a subsidiary company, or they could be two different subsidiaries in the same multinational group. Now, everything remains the same, just that they are now related to each other. So company F now sells the commodity to company I, which is its related party, and company I now sells the commodity to third-party customers. Now what happens is that the cost price remains the same for company F, because this is a third party cost. You cannot really manipulate a third party cost right here. So that remains the same at $1,200. Now, company F decides that we will not sell the commodity to company I at the market price, which is $1,400. Let's just maybe manipulate the transfer price a bit and let's sell it at $1,300 right here. Now, where is this $1,300 coming in from? Well, it's just, a price which is inflicted because of the relationship that exists between company F and company I. So now they decide to sell the commodity at $1,300. And so the cost remains the same at $1,200. And finally, the profit is $100 in India. So $100 of profit right here. And tax remains the same at the rate of, tax percentage remains the same at the rate of 30%. So that actually gives us $30 right here. Now the commodity passes on to, company I. So they have purchased the commodity for $1,300 right here. They are still expending $100 on the commodity. Because this remains the same again, because this is a third party cost and you cannot really manipulate a third party cost right here. And finally, they're selling the commodity at $1,600. Again, $1,600 is also something that you cannot manipulate, because $1,600 for sale of goods is being passed on to third party customer. So the third party customer will always purchase at the market price right here. So sale price is 1,600, purchase is 1,300, and the cost is 100, and the profit now becomes $200 in Singapore. $200 of profit taxed at the rate of 17% gives us 34. And now, if you look at the total tax that this particular group has paid, which is company F and company I put together, when they are related parties, actually comes to 64. So if you see the difference between when the companies were unrelated to when the companies are now related, there has been a group tax saving, so to say, of $13 right here. And this exactly was the problem with related party transactions. Why did $13 of saving happen? Well, that is because these related party transactions happened at something which was called as incorrect pricing. This pricing was unjustified. This pricing was a misprice that happened between these related parties. And this is precisely the issue of tax avoidance that happens between related parties. This is also a scenario of something called as profit shifting. You must have heard about how related party transactions have a tendency, or could have a tendency, of shifting profits from a high tax jurisdiction to a low tax jurisdiction. This is precisely how the companies have shifted $100 of profit from India, which was a high tax jurisdiction in this example. They have shifted it to Singapore, $100 of profit, which was a low tax jurisdiction. And this exactly is the problem which transfer pricing really intends to address. Now, this could be, there could be other situations also. This could include a lot of transactions. Some of the common ones are basically, let's say transfer of intangibles. Now, this is where how much is the royalty that is to be controlled. Royalties could be paid by high tax countries to low tax countries for the use of those particular intangibles. So this is where the scenario basically happens. This could also include allocating excessive overhead costs to a particular subsidiary if it's in a high tax jurisdiction, etc. So a lot of situations could happen looking at the same basic premise, which is moving of profits from high tax to a low tax jurisdiction, or engaging in something called as mispricing or unjustified pricing. So this is where we have transfer pricing actually come in. Now, what exactly is transfer pricing, and how is it really helping us to solve this kind of problem that we just discussed? So, well, transfer pricing is an anti-avoidance law. When I say it is an anti-avoidance law, well, transfer pricing is not like a tax per se. Transfer pricing is not like equalization levy at the rate of 6%, 2%. It's not like corporate tax. It's not like a percentage that you would have right here. But transfer pricing is basically a law. And this particular law is also called as anti-avoidance law. But this particular law actually came in to counter that particular problem. It's a law that will actually prescribe that, listen, at what price should transactions happen between related parties. So going back to this particular problem, to this particular case study, if we have transfer pricing regulations applicable here, well, transfer pricing law will come in to tell us that what is the price at which company F and company I should have transacted when they became related to each other. So certainly they should not have transacted at $1,300. So should they transact at, let's say, $1,200, or should they transact at $1,400 because that's the market price, or should they transact at some other price? What is the price at which they should transact? That is basically the entire transfer pricing law. So if you want, transfer pricing to be applicable, for the application of transfer pricing law, there are these three things that need to be established. One, well, there should be a transaction between associated enterprises or a transaction between related parties. Because, if transactions are happening between independent parties, they are as it is happening at, the market price, the open market price. But when transactions happen between related parties, that is where there could be a tendency to manipulate transfer prices, and that's where the law actually comes into play. So there has to be related parties. And looking at the income tax regulations of 1961 and 2025, we will delve upon how two parties could become associated to each other. We'll talk about that. Then there should be a transfer of property or services. There should be a transaction relating to that. And finally, there should be a cross-border transaction, as in there should be an international transaction out there. We will also be discussing the definition of international transaction as per the domestic regulations that we have. But these are really the ingredients where transfer pricing law would become applicable. There are some countries around the world where we have transfer pricing applicable to domestic entities also. And that is, in India, we have the concept, and that is called as specified domestic transactions. But more so, we will be talking about, the applicability of transfer pricing provisions on associated entities in an international tax scenario. So the point is that, when international transactions between associated entities, they need to happen at something called as arm's length price. So going back to the case study, what is the price at which related party transactions should happen? And an international transaction like this, well, they should happen at, let's say, 1,300 or 1,400 or 1,500 or 1,200, but they should happen at something called as the arm's length price. Now, the point is, what exactly is this arm's length price? Well, very simply put, arm's length price basically means what is the price at which independent enterprises are transacting at. What is the price at which unrelated parties are transacting at? So you would tell me that, listen, they are happening at open market price. Is that really the arm's length price? Well, to some extent, yes, but there is another aspect to it. So arm's length price is the price at which independent enterprises are transacting, but in comparable situations. What does it mean to have comparable situations? Well, if you want to adopt the independent party price as the arm's length price, you should make sure that it is happening in comparable situations. What do I mean by comparable situations? Well, you could, going back to the case study, you could take the $1,400 right here as the independent party price, as the arm's length price. But for that, you have to make sure that they are transacting in comparable situations, as in the type of the product should be the same. So if independent, so if let's say my related party transaction, or a client has approached me, which is basically undertaking a related party transaction, and they are manufacturers, and they are manufacturers of, let's say, pens. Well, then I'll have to make sure that the independent party price that I take as the arm's length price should also be a manufacturer, and they should also be manufacturing pens. So one, the type of the product should be the same. Well, the second thing is that if you, as a related party, a related party are a manufacturer, then please make sure that the independent party is also a manufacturer right here. We're not talking about distributors and service providers, because that could just impact the price in a very, very different manner. The third thing you have to make sure is that the economic circumstances are also the same, and also you have to make sure that the time of the transaction is the same. When I say economic circumstances, well, it's just beneficial that if this particular transaction, which is a related party transaction, is an India to Singapore kind of transaction, please make sure that the independent party transaction is also an India to Singapore kind of a transaction. And finally, you'll have to make sure that the time of the transaction is the same. As an example, if the transaction between related parties is a post-COVID transaction, then it would not be justified to compare it to a pre-COVID kind of a timeline. But yeah, so this is what I'm really trying to say, is that if you want to, that is basically the arm's length price. What is the price at which independent parties are transacting? But in comparable situations, that should be the arm's length price. Now, the next question is, where is arm's length price really coming in from? Well, it's coming from this term which is called as arm's length principle. Arm's length principle is basically the international consensus on transfer pricing. When I say that it is an international consensus on transfer pricing, it's basically a standard which will make sure that the transactions between related parties, they are happening at open market value or at arm's length price. Now, it's an international consensus because all around the world, if you see, majority of the jurisdictions, they also use arm's length principle. They also use arm's length price. And this is the reason we call the arm's length principle as the international consensus on transfer pricing. But where is arm's length principle coming in from? Well, arm's length principle is coming from Article 9 of the OECD Model Taxation Convention, and that is basically called as associated enterprises. Now, if you actually read through this particular terminology, this particular paragraph right here, this is an excerpt from Article 9 of the OECD Model Taxation Convention. And no doubt, this is the first reaction that we generally tend to get when we look at this particular arm's length principle. But let's take a minute and read through this particular excerpt from Article 9. So it says, where conditions are made or imposed between two associated enterprise in their commercial or financial relations, which differ from those which would be made between independent in enterprises, then any profits which would, but for those conditions, have accrued to one of the enterprises, but by reason of those conditions have not so accrued, may be included in the profits of that enterprise and taxed accordingly. I know, a little confusing, but let's see what it really tries to say. Well, it's trying to say that, when you see independent parties transacting, as in parties that are not related to each other, there are always, some commercial and financial relations that exist between them. What are these commercial and financial relations? Well, what is the price of the commodity? What are the conditions of transfer? What is the credit period? How will payment be made, etc.? Those are, the commercial and financial relations that actually exists between independent parties. But the problem is that when associated parties, when they transact between themselves, these commercial and financial relations may not be exactly present, or they might be a little different. And because of that, there could be like a profit difference out there. So I'll explain this with the help of this particular case study. Well, when independent parties were transacting, they were transacting with respect to these commercial and financial relations. And because of those commercial and financial relations, as in demand and supply, they were able to transact at $1,400. But when related parties, they started transacting and everything remaining the same, in comparable situations, well, they did not transact at $1,400 because the commercial and financial relations were very, very different in associated enterprises. So this is the reason they transacted at $1,300. If we look at this particular situation from an Indian perspective, how did that impact India? Well, if you look at it from an Indian perspective, initially the profit was 200, but because of the difference in commercial and financial relations, the profit is now 100. So, if transfer pricing provisions are applicable, transfer pricing provisions will make sure that there is an addition out here, and the addition will be to the profit here, and the addition will be $100 right here, and then they would be taxed accordingly, as in then they would be taxed at 200, which will give us a tax of $60 right here. So this addition is also sometimes referred to as a transfer pricing addition, and it is also in technical terms referred to as primary adjustment. And this is exactly what Article 9 is really trying to say, that if those conditions are different from independent parties, then the profit will be added, and finally the related parties will be taxed accordingly on that adjusted profit right here. So that is the arm's length principle, and I think that summarizes the entire gist of how transfer pricing actually comes into place. So that is an international perspective because that is coming from the OECD Model Taxation Convention. But the point is, how is transfer pricing placed in India? What is the domestic law framework with respect to transfer pricing provisions in India? Well, if you look at transfer pricing regulations in India, it was the Finance Act of 2001 that actually introduced transfer pricing code to India. And as far as Finance Act 2001 was concerned, they introduced Chapter 10 to India, and Chapter 10 is called as Special Provisions Relating to Avoidance of Tax. This is also Chapter 10 of the Income Tax Act of 2025. So, it remains the same. The chapter remains the same. And Chapter 10, as far as the 2025 Act is concerned, is also called as Special Provisions Relating to Avoidance of Tax. So the point is, why is this called as special provisions relating to avoidance of tax? I mean, why is Chapter 10 not just worded as, let's say, transfer pricing provisions? Much simpler. Even the 2025 Act did not say transfer pricing provisions. Even the 2025 Act says, Chapter 10, special provisions relating to avoidance of tax. Well, this is where the concept around GAR and SAR comes into place. Heard about GAR? Well, GAR is General Anti-Avoidance Rules. General anti-avoidance rules basically say that when there is an impermissible avoidance agreement, then a particular transaction could be disregarded. It could be recharacterized by the tax authorities, etc. So when as in an impermissible avoidance agreement, in the sense that when the tax authorities find out that the only reason that an arrangement has taken place or a transaction has taken place is for avoidance of tax, then they will recharacterize the transaction accordingly. But if you look at chapter 10 right here, that is called as special provisions relating to avoidance of tax, more like SAR, not like GAR, which is general anti-avoidance rule. These are special anti-avoidance rules. And this is the reason they don't call transfer pricing under the purview of GAR. They have kept transfer pricing under the purview of SAR. SAR, in the sense that these are very, very specific provisions relating to avoidance of tax. There was tax avoidance happening, and why was this tax avoidance happening? Well, that is because it was between related parties specifically. So there were special provisions that actually came in to plug those particular tax avoidance strategies, and this is the reason transfer pricing regulations are actually called as SAR and not GAR. Now, if you read through chapter 10, they actually have sections. They have sections 92 to 92F that actually deal with a transfer pricing code for India. We also have, this is in sync with the 2025 Act, we have section 161 to section 173 of the Income Tax Act of 2025, which deals with the transfer pricing provisions in India. If you talk about the current Act, 1961 Act, well, then it is Rule 10A to 10T of the income tax rules that actually are read in sync with section 92 to 92F of the Income Tax Act of 1961. So now the point is, if you read through section 92 of the India's Income Tax Act, it says that if there is a transaction between international transactions, it should conform to something called as the arm's length price. Meaning to say that even India is in approbation of the arm's length price. This one that I was talking about, that the arm's length principle is the international consensus on transfer pricing. That is what we have here also. That is section 92 of the India's Income Tax Act, and it's also section 161 of the Income Tax Act of 2025. Now, we know that this is where transfer pricing provisions are actually applicable. So now I will be explaining what are associated entities and what are international transactions for the purposes of India's transfer pricing code. The point is that if this is not covered within the definition of associated enterprises, and if it is not considered as an international transaction, well, then transfer pricing provisions will not be applicable. There will be no compliance that would be required, etc., from an Indian transfer pricing stand, and arm's length standard would not need to be maintained. So this is the reason we need to exactly know what are associated entities for the purposes of India's Income Tax Act. Well, this is section 92A, subsection 1 of the Income Tax Act of 1961, and it also corresponds to section 162 of the Income Tax Act of 2025. Now, the thing is that section 92A is generally the section for associated enterprises. Subsection 1 will give you a very generic definition. However, subsection 2 will give you a very, very precise and specific definition of associated enterprises. And this exactly, two of them together, they form the definition for associated enterprises. So let's look at what section 92A subsection 1 has to say. Now it gives us a very generic definition in the sense that it says that if, one enterprise, it participates in the management, control, or capital of another enterprise, well, then the two enterprises are related to each other. I'll say that again. It says that if one enterprise is participating in the management, control, or capital of the other enterprise, well, then these two enterprises will be associated to each other. and transfer pricing provisions will be applicable. But the point is, what exactly is management control and capital? Well, these are not defined terms for the purposes of transfer pricing. So, what is management, what is control, and what is capital is still not defined really for the purposes of transfer pricing. We'll have to look at other relevant laws. Generally, this is what we do to look at what is the meaning of management, control, and capital. And there's one more thing that we do. I will just talk about that in subsection 2. But these are not defined terms, and we generally look at judicial decisions to look at the definition of management, control, and capital. But what is interesting is that India does not just talk about a direct participation. It also talks about something called as an indirect participation in management, control, and capital. And that actually widens the scope of transfer pricing in India. So, what is this indirect participation? Well, this is how it actually starts. Let's look at the first situation right here. In this situation, company A is participating in the management, control, and capital of company B. And this is the reason company A and company B will become associated to each other directly. Then, company A could also participate through an intermediary in the management, control, and capital of company B. How is indirect participation? This is basically called as indirect participation. How can this be possible? Well, maybe company A holds shares, or it holds capital in this particular intermediary, and then this intermediary holds capital in company B. Well, then company A and company B could become associated to each other. So this is what is meant by indirect participation in the management, control, in capital out there. Now, it could also happen that there is one person right here, and this one person is participating in the management, control, and capital of company 1. And the same person, this one person, is participating in the management, control, and capital of company 2. Well, because this is a common person right here, this could make company 1 and company 2 as associated to each other. So this is also possible with respect to Indian transfer pricing provisions. And it's not just Indian transfer pricing provisions. This is coming from Article 9 of the OECD Model Taxation Convention. So it's relevant from an international tax perspective also. So it's relevant from the OECD transfer pricing guidelines perspective also. So what I'm really trying to say is that these are the situations, by which two entities could become associated to each other. But isn't it very vague without, the definition, without knowing what is management, what is capital, what is control? Isn't it, like too wide for a definition to exist? Well, yes. And that is precisely why we have section 92A, subsection 2 of the Income Tax Act. Now, if you look at subsection 2 of the Income Tax Act, it actually gives us these 13 instances right here. And these 13 instances are very, very specific things that the Income Tax Act has actually provided. And they basically say that if you fall under any of these 13 instances, if one entity falls under any of these 13 instances, well, then they will be deemed to be associated to each other. Now, what we've actually done is we've divided these 13 instances by virtue of capital, management, and control. Now, this is where I'd just like to mention that it's not the act that actually divides these 13 instances. If you read through subsection 2, it's just given these 13 instances. But it's just for, the purposes of, it's just for our basically purpose that we have actually identified these 13 instances under capital, management, and control. So let's look at these particular 13, instances right here. The first one that we will be devoting, a little time to, because I think this is a specific topic. Associated entities is a topic that I think, go on for about 4 hours, but 3 hours, 4 hours. But just giving you a summary of what the capital instances actually look like. This is what it actually looks like. So if you read through these sections in green, this corresponds to the Income Tax Act of 1961. And I have also written the section in the Income Tax Act of 2025 also. So the green one is for 1961, the purple one right here is for 2025. They are majorly, the same right here. But let's look at the capital instances right here. The capital instances, basically talk about direct or indirect holding of shares carrying 26% or more of voting power. Or they also talk about direct or indirect holding of shares carrying 26% or more voting power by same person in each enterprise. What does that mean? Well, it just tries to say that if company A has 26% or more than 26% share capital in company B or voting rights in company B, then company A and company B will become associated to each other. Even if it is through an intermediary, they will become associated to each other. Even if there is a same person which is holding 26% or more, 26, 27, 28%, whatever it is, or more voting power in company 1, and they also hold 26% or more voting power in company 2, well then because of that common person, company 1 and company 2 will become associated to each other. But you know what, that is absolutely fine. This is what the law actually says. But then the thing is, would preference share capital holding count? Well, not really. And that is because this is where we need to interpret the law, because it says voting power right here. So it is actually equity share capital that we're looking at, and not preference share capital, so much. The third provision talks about, similarly, there are other provisions which talk about, let's say, provision of loan not less than 51% of the book value of total assets. So if one entity provides, loan to the other entity, and this is 51% or more of the book value of the total assets, then that is also seen as association. Even if one entity gives guarantee on behalf of the other entity, and this guarantee is 10% or more, well, then also there will be association. So these are really capital, provisions right here. There are small things that, you need to actually take into consideration. So, when we talk about loan, it is actually the book value of the assets. We're not looking at the market value, we're looking at the book value, right here to actually look at association. What is also very interesting is that if you look at the law right now, it says at any time during the previous year. So, this is very interesting. This is a very interesting thing which has come out by using the terminology at any time during the previous year. So, this basically means to say that, let's say, for the majority of the year, there was not much association. Let's say one entity is holding 20% voting power in the other entity. But through the last 3 months of the tax year, or through the last 3 months of, let's say, the previous year, they actually reached 27% voting power. Well, this basically signals that they will still become associated to each other, because the law is worded in a manner that it says at any time during the previous year. Even if one entity has not provided loan through the entire year, but towards the end of the tax year, they provide a loan of 51% or more of the book value, then they'll become associated to each other. And that is because the law says at any time if this association is reached, then they'll become associated to each other. The next set of conditions, or the next set of instances, are basically management driven instances. This is where they actually try to say that if one enterprise appoints more than half of the board of directors in the other enterprise, then they'll become associated to each other. So, or it actually says that if one enterprise provides or actually appoints one or even more than one executive director in the other enterprise, that appointment will make sure that the two enterprises are associated to each other. They become related to each other. Now, this is, again, this is what the law says. But what is very interesting is that they actually talk about board of directors, and they talk about this thing called as governing board. Now, this is where we're not really looking at, those remuneration committees and audit committees, etc. But we are actually looking at governing boards right here. What is also very interesting to be pointed out here is that we are looking at appointment of executive directors. So the point is, do you think independent directors, would count? Well, not really, because independent directors are non-executive directors, and this is where the law says appointment of executive directors will count as association. So these are, I think, some of the small points that are to be taken, that are relevant and should be taken into consideration while looking at, association for a client like situation. Now, the third set of, conditions are basically control driven instances. When I say control driven instances, well, in the present act, they start from clause G and they go into clause M, right here. Now, these are where, when you read through these particular instances, you will actually see how, when one enterprise actually exercises a lot of control on the other enterprise. How can control be exercised? Well, it could be, let's say one enterprise is thriving and it's doing their, manufacturing, or they're doing their business, or they're doing their processing based on intangibles. And where are these intangibles coming in from? IP. Well, where is this IP coming in from? Well, for the IP, they are completely dependent on another enterprise right here. As in, there is 100% dependence on the intangibles which are owned by another enterprise. Well, then you know that two enterprises are associated to each other because there is so much control right here. This particular enterprise cannot function without intangibles, and they are completely dependent on those particular intangibles to the other enterprise. So then you know that, by virtue of this particular control through intangibles, the two enterprises will be related to each other. Now, these are, some of the control related instances. This could be common control. Let's say that there is an individual which controls a company, and the individual's, let's say, daughter controls another company. Well, then these two companies will be associated to each other. Why? Well, that is because there is common control by the individual and their relative put together. Daughter is a relative for the purposes of Income Tax Act. So the individual and the relative put together, they are controlling this company, company one, and the daughter is controlling company two. So because there is common control, they could be associated to each other. So these are, this common control could be from the perspective of HUF also, and the control could be, from the perspective of firms, AOPs, association of persons, body of individuals, etc. also. So these are, some of the control instances by virtue of which two entities could be associated to each other. There is also another clause, which is M, which says there could be a relationship of mutual interest, but nothing has been prescribed as yet. So that remains, the same. So what I'm really trying to say is that they did come up with subsection 1, which talked about a generic definition right here, this one. But then this is where they also came up with subsection 2, and subsection 2 really talks about these specific instances. And if two entities, they fall within any of these 13 specific instances, they will become associated to each other. And then transfer pricing provisions would have to be undertaken compliance, especially if it is an international transaction. So this gets us to the next topic, which is what are international transactions? Well, there was a time before 2012 that the definition of international transaction was very, very restricted. But then in 2012, there was an amendment that came in, and the scope of international transaction is now so widened right here. So this is where the definition of international transaction is provided in section 92B of the 1961 Act, and this corresponds to section 163 subsection 1 of the 2025 Act. And this is where they've given like a variety of transactions. These could be tangible property transactions, as in, let's say, a building, a vehicle, if there is sale, purchase, or even transfer or use or, lease of a building or a vehicle, machinery, etc. So tangible property transactions. Even intangible property transactions are included. So, if there is use of intangible, there could be transfer of, or, transfer of the ownership of a particular intangible, etc., etc. That is also, covered. And this was also the 2012 Act. They've given a specific definition to this particular terminology, which is intangible property. From the tangible property is very, very wide, and you'd see it provided in section 92B itself. So you can have a look at that. So yes, intangible property transactions are also included as international transactions. Then they came up with also capital financing transactions, meaning to say that if one entity provides, let's say, borrowing to the other entity, they lend money to the other entity, or they provide guarantee, let's say, to a bank on behalf of this particular entity, or even if there is purchase and sale of shares, if there is outstanding receivables, outstanding payables, etc. These are all within the purview of international transactions. Also, provision of services. So if one entity provides, let's say, information technology, IT services to the other entity, that is a valid international transaction. These services could be anything. There could be, development or technical services. It could be accounting services. It could be legal services, software development services, KPO, BPOs, etc. They're all covered within the definition of international transaction. And finally, the definition is so wide for international transactions that they also include business restructuring transactions. So, let's say that there is a manufacturer, a full-fledged manufacturer that decides to now convert into a toll manufacturer, or a contract manufacturer. So there is a full-fledged manufacturer converting itself into contract manufacturing. That is basically, that could be something called as business restructuring, mergers, acquisitions, etc. Those are all within the purview of business restructuring right there, and those are also considered as valid international transaction. When you look at a compliance form for transfer pricing, it's called as the accountant's report. It's also called as form 3CEB. You will see that there is segregation clause wise in that particular form for all these particular transactions. So you can fill up the relevant transaction, whatever happens between associated enterprises right there. So what I'm really trying to say is that if there is a transaction between associated enterprises, and this transaction is a valid international transaction as per section 92B, well, then transfer pricing provisions will be applicable, and you will have to make sure that this transaction has happened at something called as the arm's length price. So that is the essence of transfer pricing. And obviously, you will have to, file in for, the compliance on behalf of the clients, etc. But that's really, the essence of transfer pricing. So the point is, yes, now we do know, we have a little clarity on what are associated enterprises. We have some clarity on, the concept of international transactions. But then how do we really compute arm's length price? I mean, how do we determine arm's length, price? Yes, you did say that independent party price is the arm's length price. But then how do we find out independent parties? And what if, we're talking about, let's say, a unique transaction that has not been undertaken? Maybe, let's say, an intangible transaction. Where do we actually find out, the price of that particular transaction from? How do we do that? Well, that is where we have some methods which are provided to compute the arm's length price. So these are, the methods right there. There are these, traditionally there are these two kinds of methods. We've just, divided the methods into two kinds. There are some traditional transaction methods, and then there are some transactional profit methods right here. If you look at this particular slide for the first time, it could get a little overwhelming, but then with time and then, with practice, you could just get very, very used to these particular methods. So there are these traditional transaction methods. These are the comparable uncontrolled price method. It's also called as CUP. There is something called as the resale price method. It is called as RPM. Then there is something called as the cost plus method, which is also called as CPM. And then there are transactional profit methods, which are called as the transactional net margin method, TNMM. And then the profit split method, which is called as PSM. Now, what exactly are these? Well, when you look at, the traditional transaction methods, which are basically these three, those are more like, those direct methods that are available. When I say direct methods, it basically means that, the more easier, as such, there are less adjustments that are required. They're not really a lot complex, and they deal with the price as such. If you see, it talks about the price here, it talks about the resale price here, and it talks about the cost plus, again, a form of the price right here. So those are more direct in nature. But then when you have, unique contributions, when you have unique transactions right here, that is where the profit methods come into play. So this is going to be on the net margin, and this is going to be on, the profit split, method right here. So these are the two kinds of, methods that we have, but 5 methods all in all. This is what is provided in the OECD transfer pricing guidelines, that there are 5 methods that are provided to compute the arm's length price. However, if you read through Indian transfer pricing regulations, they also have something called as the 6th method right here. And the 6th method for the purposes of India is called as the other method. The method is called as other method. I have provided it right here. And we will be, talking about the other method also. It's coming from Rule 10AB of the income tax rules. We will be talking about this. But what I'm really trying to say is that when it comes to OECD transfer pricing guidelines, they have 5 methods. And as far as India is concerned, they have 6 methods to compute the arm's length price. So when you talk about the methods, Kriti, how will we know, because there are multiple methods right here, how will we know which method to actually use when? Well, there was a time that internationally there was a hierarchy of method in place. A hierarchy in the sense that you use this method first, then this, followed by this method, and then finally this particular method. But then the point was that hierarchy internationally has now been removed, and India also is in approbation of that particular approach. India has also done the same thing. India has also removed that hierarchy of method. And what we have in India now is something called as the most appropriate method. When I say the most appropriate method, well, there are, you have to look at the facts and circumstances of your client situation, and accordingly, you have to choose, your method. Giving you an example, is your client a trader? Well, is your client a trader? Well, yes, you use the resale price method. Is your client a manufacturer? Well, then you use the cost plus method. So, they've given us some facts and circumstances right here, and that is where they actually help us select the method. That particular concept is called as the most appropriate method. So now we've moved from a hierarchy of method kind of a situation to something called as MAM, which is the most appropriate method, which basically means to say that, whichever method provides the most reliable measure to calculate the arm's length price, well, use that particular method. So now we will be discussing what exactly are, these methods. Let's start with a method which is everyone's favorite. It's called as the comparable uncontrolled price method. This method is very simple, and that's how it's everyone's favorite. When I say that it's simple, it's also the most direct method. What do you do in the comparable uncontrolled price method? Well, you look at an independent party situation, and you could use that independent party price as your arm's length price. Just make sure that these factors are the same. So when so going back here to this particular case study, if you want to, obviously we know that 1300 right here is not the arm's length price. This was a manipulated price that the related parties were actually transacting at. This was not the arm's length price. So the point is, what exactly is the arm's length price? Well, if you want to use the CUP method in this particular situation, well then the use an independent party price. This was 1400, an independent party price. But is it in comparable circumstances? Well, you have to make sure that the type of the product is the same. Those comparability factors that I just mentioned, that the type of the product is to be the same, the economic circumstances has to be the same, the time of the transaction has to be the same, the business strategies and, the functions like the manufacturer and the distributor kind of things, they have to be same, etc. If all those conditions, if all those comparability factors are actually the same, then you could say that this $1,400 is the arm's length price, and this is the price at which related parties should have transacted, and not $1,300. How did you arrive at this particular price? Well, using something called as the comparable uncontrolled price method. Uncontrolled price is like a fancy terminology to independent party price. It's uncontrolled, as in it's not an influenced price. That's how we call it, an uncontrolled price. So uncontrolled price in comparable situations, that is basically the CUP price. That is basically the comparable uncontrolled price right here. Now, as far as CUP is concerned, there could be two CUPs that could be possible. There could be something called as an internal CUP, and there could be something called as an external CUP. An external CUP is precisely what we discussed right now. Let's take this example right here. Let's say that there is an associated entity 1, and they are selling unbranded Colombian coffee beans to associated entity 2. Now, we need to ascertain whether the price at which they are transacting is the arm's length price or not. What do we do? Well, we find out an independent party in the same circumstances. When I say independent party in same circumstances, they are also referred to as comparables, comparable companies. Let's look at a comparable company in the same industry. Well, we have this non-AE1 selling same unbranded Colombian coffee beans to non-AE2. These are not associated to each other, and so they are independent parties. These are comparable companies, or they're also referred to as comparables. They are also selling unbranded Colombian coffee beans. What we can do is, because the type of the product is the same, and considering all the other factors were also the same, we could adopt this price as the price for this related party transaction. So if this is happening at $1,400, we could take $1,400 as the arm's length price for this kind of transaction. That is called as external CUP. Why is this called external CUP? Well, because we were able to find out external transactions, right here. Similarly, what is internal CUP? Well, internal CUP basically is this kind of a situation. Let's say that there is a parent company FCO, and then there is a subsidiary which is called as ICO. ICO is actually selling unbranded Colombian coffee beans to FCO, and this is a related party transaction. We need to find out if the price at which they are undertaking the transaction is at arm's length or not. How do we do that? Well, This is where we discover that ICO is also selling unbranded Colombian coffee beans to some random independent enterprise, which is non-AE, here. So what we can do is we can use this particular price as the arm's length price for this related party transaction. And this is called as internal CUP. Why is this called as internal CUP? Well, that is because we were able to find out the transaction internal to the firm itself. We found out that this party was, relevant to us. It was internal to the organization, and this party was not just selling it to related party. This party was also selling it to unrelated party. This is the reason we can use this price as, the price to benchmark this kind of, transaction. So this is called as internal CUP. The next kind of method that we have is resale price method. It is generally said that resale price method is relevant for traders and distributors. This is a situation where a particular product is resold. Let's say that there is a parent company and the parent company sells a commodity to the subsidiary company. The subsidiary company sells the same commodity to an end customer right here. But then the specific point for resale price method is that the subsidiary company does not add substantially to the value of the product. There is not much value addition to this particular product. So they're just reselling the commodity because subsidiary company is in the nature of a distributor. They're just distributing the commodity to their jurisdiction right here. So this is where resale price method will be applicable. So if the parent company is selling the commodity at 75 to the subsidiary and the subsidiary company is selling the commodity at, let's say, 100 to the end customer, we know that the subsidiary is making a profit margin of 25%. As long as we are able to justify that there are other parties in the market who are also traders and distributors, and they are also earning a profit margin of 25% or a profit of 25 from this kind of transaction, we can ascertain that this is at arm's length price. This transfer price of 75 is at arm's length price. There might be a question that might be coming to your mind right here, which is, Kriti, how do we really find out independent, how do we really find out independent parties right here? um, well, there are softwares that we have, there are databases that we have for transfer pricing, purposes, and using those particular databases, and by putting in appropriate filters right here, we can actually find out independent parties and using the same scenario right here. I think we'll have maybe another discussion altogether on how we could actually find out these comparable companies. How do we really use these softwares? What are the filters? What are the softwares in India, etc.? But this is, primarily the concept right here. The next method is something called as the cost plus method. Now, cost plus method is specifically applicable for, manufacturers. This is where, let's say the subsidiary company is a manufacturer and they have cost of production, cost of manufacturing as 100, but then they sell the commodity to the parent company at 125. Now, as long as you're able to justify the 25% profit margin of the subsidiary company in the manufacturing activity, you can actually justify that this transfer price is at arm's length. So again, for this particular purpose also, we have to use these transfer pricing databases. But as long as you're able to justify it, it's absolutely fine. So this is mainly applicable for manufacturers. As the name of the method also suggests, cost plus. There is a cost plus there is a profit markup for these manufacturers, and that is basically the cost plus method. The fourth method that we have is something which is very widely used, and it's actually applicable for most category of transactions. This is basically called as the transactional net margin method. Now, in case of transactional net margin method, we basically compare the net profit margin. Let's say that there is an Indian company which is, let's say, providing IT services, information technology services to a USA company. Well, let's say that they are earning a profit margin, a net profit margin of 15%. So when the Indian company is providing, information technology services to the USA company, the Indian company is earning a net profit margin of 15%. Now, if you want to justify that, if this particular is a related party transaction and this is also an international transaction, so we need to justify that this 15% of margin, which is earned by the Indian company, is at arm's length price. How do I do that? Well, you could use TNMM method for that. You could use the transactional net margin method for that. But then for this, you'll have to find out comparable company in the industry, which is also an Indian company, which is also providing information technology services to a USA company. If you're able to compare the profit margin and that actually comes out to be, in comparison, well, then this is going to be certified that your related party transaction is at arm's length. So, what we actually compare in the transactional net margin method is called as the profit level indicator. What is this profit level indicator? Well, this is like a ratio, net profit by an appropriate base. What you actually compare is this particular ratio, net profit by cost of the client situation is actually compared to the net profit by cost of the independent party situation. If it is comparable, well, then this is justified to be at arm's length price. This is, quite a frequently used method. It's not just for IT services, but a host of services that, this could be a host of transactions that this method could actually be used for. IT services, ITES services, software development services, etc. This particular, method could actually be used. And what this particular method compares is the net profit, the profit at the operating level, the profit at the net profit, level. Now, what is very relevant for everyone to know right here, as far as TNMM method is actually concerned, is this concept of something called as the tested party. What is the tested party? Well, I just mentioned that, let's say the Indian company provides IT services to the USA company. Now, there are two situations possible right here. You could calculate the profit margin, the net profit margin at the Indian entity's level and compare it with other comparables in India, which is 15%, like, we just presumed. Or you could do the same calculation from a USA perspective. So you could actually compute the profit margin of the USA entity and compare it with comparables in USA itself. But what will you do? Well, you could do anything, and that party that you actually choose is going to be called as the tested party. So the verification of this kind of transaction is done from the perspective of tested party. Whether India could be a tested party or USA could be, a tested party right here. There was a time that we used to have a lot of, litigation in the country with respect to this issue, that, you cannot take the foreign entity as the tested party, but it's quite, settled. It's absolutely fine. The point is that there is no definition to tested party in the OECD or even the Indian transfer pricing regulations, but they generally say that whichever entity you feel is the least complex, as in, whatever entity that you have information available for, they should not have intangibles, and, they should have least adjustments right there, that, the least complex entity is generally considered as the tested party. So you could actually, do the calculation for any of, the parties right here. But that really is the transactional net margin method in, a concise form. So what you do in the TNMM method is to actually compare the net profit margin. The fifth method that we have is basically called as the profit split method. Well, this particular method is applicable one when you have unique intangibles. The moment you have, very unique transactions relating to intangibles, that is where this particular method is going to be applicable. Or when you have so many transactions just so interrelated in a manner that you cannot divide them on an individual basis. Let's say for TNMM, I just mentioned that this was an IT transaction. But what if there are a lot of transactions combined and I cannot really segregate these particular transactions? Let's say that there is manufacturing activity, there is research development activity, and all these provision of services kind of transactions all related to each other combined, and I cannot segregate them properly. Well, that is where PSM actually comes into place. And for the purposes of PSM, what we do is we calculate the combined operating profit from this intercompany transaction, and then we allocate this combined profit to different entities. So there is allocation right here. So step one, combine the profit, and step two, allocate the profit between different entities. And this allocation, this profit split percentage, could be done by looking at what independent parties do in comparable situations. So that is profit split method. And finally, what we have from an Indian perspective is something called as the other method. Other method is basically, it's basically based on quotations rather than the actual prices right there. The other method actually uses this particular terminology that I've highlighted on the screen. It says the price that would have been charged or paid between two entities right here. That's basically the other method. If you look at the other method, it's not like an actual transaction, but mostly quotations that are actually used. It's generally that we use this particular method for the purposes of reimbursement transaction. So if there is a transaction relating to reimbursement that the Indian entity has gotten from, let's say, a foreign parent, etc., for those kind of transactions, you could use the other method. It's very interesting, that this particular method, which is the other method, it does not find place in the OECD transfer pricing guidelines. UN has made a reference to it by saying that there are jurisdictions that actually use the other method. It's also called as the commodity rule. But then OECD does not make, OECD does not talk about the other method. India, because it follows the UN transfer pricing guidelines, it actually uses something called as the other method. So it's something which is very jurisdiction specific. You'll have to read through the domestic law of different jurisdictions to see whether they follow the other method or not. And finally, this is a slide which could probably help you determine the choice of the most appropriate method. As I mentioned, the concept is now called as most appropriate method. What are the methods? What method will be applicable? It's actually dependent on the facts and circumstances of a particular, client situation. Obviously, this is just a slide in reiteration, in summary, but this is a topic which I think calls for a detailed analysis, and but this is this is the table that actually just determines what method is actually used when. This actually brings us to the entire essence of transfer pricing, which is basically what are associated enterprises, what are international transactions, and finally, how do you really determine the arm's length price? Are there disputes in transfer pricing? Well, there was a time only a lot. So, the initial years in transfer pricing, they actually had a significant amount of, litigation. India was a transfer pricing litigation rich nation at one point in time. the initial years, which is very natural also. But then as the learning curve actually improved on the subjects, the trend actually, changed a lot. So there was a time that, we had disputes around comparability analysis. When I say comparability analysis, the disputes were around, the use of a method. Should CUP be used? Should TNMM be used? Which method actually, should be used? Then what comparable companies should be used? How has, the disputes were actually based on how someone used that particular transfer pricing, databases right here. But now you'll see a gradual, change right here. And the disputes are now focused on something called as location savings, financial transactions, guarantee transactions, recharacterization, marketing intangibles had, a lot of litigation right here. So, the trend has actually, changed so much. Sorry, there was a time that obviously we do have a traditional mechanism for transfer pricing disputes. So, appeal could be made to DRP or CIT appeals, then to the ITAT, then High Court, Supreme Court. But then with this, we also have an alternate dispute resolution mechanism for transfer pricing, purposes. APA is something which is very specific to, transfer pricing, which is advanced pricing agreement. We have safe harbor rules to make sure that disputes, are lesser. We have something called as MAP for international tax and transfer pricing, situations, and obviously there is bar also. So the point is, what I'm really trying to say is that, the uh, with having alternate dispute resolution mechanisms, there has been a change in these particular disputes. What is very relevant from transfer pricing disputes kind of a, standpoint is this particular thing on, APA. What is an APA? Well, APA is, something called as advance pricing agreement. This is more like an agreement between, or like an arrangement between the tax authorities and the taxpayer, where they will determine, what will be the method that will be chosen for a particular set of transaction for a fixed period of time going forward. So if, the taxpayer has undertaken a transaction which is in litigation, they could approach APA, and under APA they will have negotiations with the tax authorities, and they could determine that, for the next few years going forward, what will be, let's say the method, or what could be the comparable companies, or what could be the adjustment for the purposes of transfer pricing. So the benefit of APA is to actually have a certainty kind of an approach. That is what APA actually provides. Then there is also something called as, safe harbor rules that we have for transfer pricing purposes. Safe harbor rules are, more like circumstances. There was not much clarity on how much should be the margin for different transactions, and this is the reason they have, the income tax authorities have shortlisted a few circumstances, as in a few transactions, and they basically say that if you undertake these kind of transactions, then this is the profit margin which is considered as acceptable. As an example, they basically say that the tax authorities basically say this is provided in Rule 10D of the income tax rules. And they basically say that, listen, if you have, let's say, software development services, well, then 20% to 22% of the operating profit margin is considered as an appropriate transfer price. It's dependent on, the value of the transaction, whether it is 20% or it is 22%. Similarly, they have given like a host of services right there in Rule 10D. Let's say they talk about, IT services, ITES services, then they talk about KPO services. They also talk about intra-group services, low value adding intra-group services, etc. So this is how, they're trying to resolve transfer pricing disputes by having these alternate dispute resolution mechanism. Obviously, the traditional mechanism is there, but this is like an added, alternate mechanism for the purposes of, transfer pricing. So in a nutshell, I think this is what the entire transfer pricing is all about. As far as, the disputes are concerned, again, this is something, APA is something, that could have 4 hours of discussion or a 3 hour, kind of a discussion. Safe harbor rules are also something which is a separate topic in itself, and I'm sure we'll have more sessions going forward to discuss these particular elements specifically in detail. But right now, in a nutshell, what I was really trying to tell you with respect to transfer pricing is where was the problem, and then how did transfer pricing come into place, and then what has India done, what is the structural provision in India with respect to the transfer pricing provisions, and finally how are disputes being resolved for the purposes of transfer pricing. With this, I think I finish with my presentation. I'm more than happy to take any questions, but thank you so much for listening to me, and just devoting your time, especially on a Monday evening, devoting your time to just listen to this particular presentation. Thank you so much.
Thank you so much, madam, for such a detailed and enlightening presentation. You have truly simplified a subject as technical as transfer pricing and given us not just the theory but also the practical insights that we will carry in our professional work surely. And as expected, it has sparked a lot of curiosity and interest among the participants. We have already received some thoughtful questions on this. So I'll now take the opportunity to place them before you, ma'am, for your valuable insights. So the first question that we have is like in practice, how do we resolve conflicts between broad definition of associated enterprises under section 92A1 and the specific instances under section 92A2?
Thank you so much for this question. I think it's very practically relevant also. So, as I mentioned, section 92A1 actually talks about a very generic definition, and 92A2 actually gives a very, very specific definition, to the meaning of associated enterprises. The point is that, when there was a time that when initially transfer pricing was actually introduced, there were notices being sent to a SESI, let's say on 25% shareholding also. 25% because it was not within this particular, limit, but still there were notices being sent. But now what you have to do is to read 92A1 in sync with 92A2. So that basically means that 92A1 and A2 has to be read together, meaning to say that it is only 26% or more share capital which will attract transfer pricing provisions. Also, I think if you see 92A2, how it is actually worded, it says for the purposes of subsection 1. So that basically means that this has to be read in a co-joint manner right here. So that is practically how we conduct and how we ascertain whether two enterprises are associated or not for the purpose of transfer pricing.
Thank you. Thank you. The another question that we have is in case of KPO transactions. So can we apply cost plus method in case of KPO transaction?
Yes, I think, I cannot necessarily, provide, like a very standard answer to this. We've seen TNMM method being used a lot for these kind of transactions, but then you will have to look at, the facts and circumstances of a particular case, whether a CPM, a cost plus method kind of a transaction, would be applicable. So you cannot, what I'm really trying to say is that you cannot just generically, just call out for a specific transaction right here, a KPO or a BPO, and then see what method will be applicable. And that is because practically, if you look at the choice of method, right there, if you look at the compliance document which is filed, let's say a TP study, if you choose to apply a particular method, you will have to reject the other methods also. So if you choose, let's say, a TNMM method for the purposes of KPO, I will have to provide in and put in justifications right there as to why CUP is not the perfect method, why RPM, CPM is not the method, why PSM, other method are not the method, and why TNMM is, the perfect method for this kind of transaction. So it's not just, like a straight jacket answer that I can provide right here, but it's actually dependent on a lot of, factors right there. And this is also what is contributing to the concept of most appropriate method. Why is something most appropriate? That is because for that you'll have to reject, the other methods right there.
Thank you. So the next question we have is, in case of financial guarantees, which is the most appropriate method to arrive at an arm's length price, which is also in line with OECD guidelines?
Again, something which is just dependent on the facts and circumstances. There was a time, if you look at the OECD transfer pricing guidelines on financial transactions, they provide CUP, as CUP is something which is standard, which could be provided as the method for sure. But then again, you'll have to look at a particular transaction. The OECD transfer pricing guidelines, even the UN transfer pricing guidelines on financial transactions, talk about a variety of instruments that you could use for these kind of transactions. So you'll have to look at that particular chapter right there.
Like the next question is, could you share your insights on the common mistakes or some pitfalls which businesses make while preparing transfer pricing documentation in India?
Oh, a lot, actually. Thank you for this particular question. I think it's again, something which is very, very practically relevant. I think as far as a transfer pricing analysis is concerned, what is very, very important is to draft a perfect transfer pricing documentation. That is very, very important. What is very important is to have intercompany transactions also right there. There is a concept, I wish to discuss international transactions in a lot of detail, but there is a concept which is called as deemed international transaction. Now, that particular concept is actually based on the concept of intercompany, agreements. So you'll have to make sure that the intercompany agreements are drafted in the most wise manner. A lot of times, I've seen intercompany agreements between businesses being made from a financial angle, from a business perspective, etc. But somehow transfer pricing is something which is, sort of left out, and those kind of transactions are also within the purview of deemed international transaction. So I think focus should be on intercompany agreements, amongst obviously, other things right there. Yes. Yes, sir.
And
The most common mistake, which only not I have seen or Kriti must have come across, but it has been pointed out by the tribunal also, is the lack of proper functional analysis.
Absolutely.
And the starting point is that you should not never. I mean, people should never resort to cut and paste. Get hold of some documentation and or some website and simply download and cut there and paste in your transfer pricing documentation. The most important thing is that you need to talk to the business people or the people on the floor, not only to the CFOs or to the account manager of a company. Until unless you talk to the people who are actually carrying out the work. If it is manufacturing, then how the manufacturing is done. If it is, the services, then how the services are done. This is very important, and people most of the time miss out. There was very interesting case by the tribunal which has come very recently. I mean, I'm sure Kriti and Akshata must have come across, and you might have also come across. Is that the taxpayer failed to establish why the management services were required by the company and whether they were received or not. What are the evidences? So and because management services or the cross charges, which we call, are very important, and those are the transactions with the income tax department look at with with a microscope. So you should not only say that it has been received. The second question is why it was received. Was there whether you have the necessary manpower to do those things for which you have made the payment to your associated enterprise, and how the work has flown to the tested party or to you. Many a time, these very basic things are missed out, and when it goes to the tribunal or to the high court, you don't have the leg room to bring out all these facts before the tribunal or before the high court. Whatever you have produced before the transfer pricing officer, do not fear that the transfer pricing officer will not accept anything and they will proceed with a fixed notion and make the addition. They may do it. But once you have produced the proper documentation before the transfer pricing officer or before the DRP, you will be able to argue those things before the tribunal and subsequently before any judicial authority. So this is in crux or in substance the most major mistake which I have come across in my professional life.
I totally second your thoughts, sir. And on that note, we've always seen, intra-group transactions, happening between entities, and this is where, from a transfer pricing perspective, there is always that need to prove the benefit test. Was that particular benefit? Was there a benefit that was being provided in those, intra-group services? And that's where, I've seen default being made. That's where there is not much evidence, and so I think on that note, documentary evidence is something which is very, very important, from a transfer pricing perspective.
I will add one very interesting fact. There was a documentation where it was said that we are providing, the back-end services, and then there was whole paragraph showing how India is important in the global setup. So the officer pointed finger on those paragraphs, and then in the website it is mentioned that the people who have contributed to the development of IPRs, there are names of many of the Indian employees. We were ready to give the reply to that, but if you have these type of things in your documentation, I mean, rest assured, I mean, one or the other officer will catch hold of that, because they are also looking at the website of the companies. They are going through your documentation very carefully. All those diligent officers, I mean, as many of the diligent, I mean, people among you. So they look at that. So please, I mean, consider documentation as a very serious matter, more important than a litigation process. Yeah, Kritik.
Absolutely, sir. I think documentation is very, very important. And within documentation, as you just rightly mentioned, FAR analysis is something which is to be, given a lot of importance. If you say that, these are the functions, that are actually performed by, the client, well, it has to be one in sync with, the intercompany agreements. And second, it has to, what the intercompany agreement says. And second, it has to also be in sync with how actually it is conducted, how transactions are conducted. I mean, maybe someone is a full-fledged manufacturer, but if they're kind of getting returns, which is evident from the financial statements, if they're getting returns like a contract manufacturer or toll manufacturer, then that there is some mismatch which can be picked up. So documentation is something which is very, very important from a taxpayer standpoint. Yeah. Over to you,
Thank you
Akshata.
so much, madam. Thank you so much, madam, for addressing all the questions with such clarity and depth. Your responses have added an immense value and have given us a more better understanding of the subject. And to our participants, if you would like a copy of this presentation, as I have received a lot of messages on that. So if your questions could not be covered due to shortage of time, we sincerely regret the limitation. You may kindly write to dtc@ici.in and the committee will be glad to assist you. With this, we come.
Just to correct, please mail to sitetax@ici.in.
Yes. Okay. Thank you, Prachi madam. So with this, we will conclude the Q&A session. And on behalf of everyone present, I extend our sincere gratitude to you, madam, for sharing your time, knowledge, and expertise with us today. We'll now move towards the closing of this session. As we conclude this insightful session on demystifying transfer pricing, I believe we are walking away with greater clarity on not just the why, but also the how of this complex subject. We explored its global relevance, the challenges of intragroup transactions, the legal framework, methods of determining arm's length prices, and the mechanisms available to to resolve those disputes. Transfer pricing at its heart is about balance, ensuring fairness between jurisdictions, safeguarding revenue, and enabling businesses to thrive with compliance and transparency. On behalf of all of us, I extend my heartful gratitude to you, madam, for breaking down this technical subject with such precision, practical insights, and global perspective. To all the participants, thank you for your active engagement. Let us carry forward these learnings into our practice and professional journeys with a renewed sense of responsibility and confidence. And on behalf of the Committee of International Taxation of I extend my heartful gratitude to our respected speakers, participants, and the organization team for making this program a success. With that, we officially bring the session to a close, wishing you all a continued growth and success. Thank you once again, everyone, and wishing you a wonderful evening ahead.
And wonderful Navratri.
Yes, yes.
Thank
Thank
you.
Thank you, sir. Thank you, sir, all.
So much, everyone. Thank you.
Thank
Thank
you.
you.
Thank you.